This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. Okay, here's the issue. So with risk, the underappreciation of the risk is what gets you in trouble. Okay, so think about 1999-2000 dot-com mania, every magazine you read, everything you saw, technology's making a ton, the getrich.com. I mean, many of you experienced that. Many of you remember that as a very, very, very amazing time in your net worth expanding. But those that went through that maybe didn't recognize the real risk that was there. I mean, you say, hey, Microsoft's going to be around forever. I'll pay $128 a share for it. Well, Microsoft very well may be around forever, but is it worth $128 a share? Probably not. Not back then, and not, I don't know if it's worth that now or not today, 10 years later. And then the next thing was home sweet home, you know. You know, when you see TV shows telling you how to flip that house or property ladder or go in and buy it and sell it in 6 weeks and you can make, you know, a bunch of money, and you see that every night on TV, you know that this is now in a period where it's a euphoric atmosphere. And a lot of people really made a fatal flaw in thinking, well, real estate can't go down. It never goes down over the long run, and it did, right? So we don't know what's next, but this is how the cycle works. So the crisis, they begin and end the same way. You have this buildup of underappreciation of risk, and it might take years. And this is a picture of the S&P 500 from, you know, 2002, sort of the tail end of the Enron, AOL, WorldCom, Martha Stewart period, moving forward for 4 or 5 years where corporate earnings expanded at just an unbelievable rate, and people continued to invest and continued to invest, prices ran up, and there was this underappreciation of risk. And then all of a sudden, when we realized how much leverage was deployed in the financial system, that began to fall apart, and we had the crisis, and then very rapidly we had wealth destruction, and then the cycle begins again, right? So you ask, well, what's the remedy? Because you know we've all seen the charts that say if you invest for a very, very long time in the stock market, eventually you're gonna be up here. But then this is the reality of what happens. So the key is managing the volatility. The key is making the downs not as down and not worrying that the ups aren't at the absolute highest. You don't have to be, I tell people this all the time, you don't have to be the person getting the very last chair before the music stops playing if you're taking profits, you know. When you've got a good profitable position and you have met your required rate of return, take some money off the table, it's okay. But this is the cruel math of big losses, and if you look at this, this is the Russell 1000, this is the 1,000 largest dividend-oriented, most stable companies as they were tracked from 2003 through the crisis in 08. There was a 50% decline. And then as we forecast forward and say, well, what if we make 8% a year, which is a lot of what economists forecast, it'd take you 10 years to get back to where you were. And, you know, as we go through life cycles, you know, if you're 30 years old, you say, well, okay, that's fine, I'll just keep on putting it. You're 40, you say, well, that's not really what I had hoped for, but whatever, you know, okay, I'll make the best of it. But when folks get into 50 and 60, which many of the folks here that we serve, I mean, that's where you're at. This prospect of a 10-year recovery is really, it paints this picture of you're just not going to reach your goal. So how do we deal with this? The key is managing volatility. The S&P 500 index is a widely recognized measure of the U.S. stock market performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is a widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years.
The Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest directly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and/or fees and expenses associated with investing.